Hey, I'm going to show you now how to use the Excel template to do a cash flow using each one of the slides on the PowerPoint step by step. To make it easier for you on the Excel file, I have used a blue font where you will be entering numbers, and everything else is in black because these are all formulas which will be recalculated. So let's see how this works. When we go to the PowerPoint, which we discussed on a previous video about Jenny Business, we said that the first transaction is when she has to book the sales. So her sales are $10,000 per month or $120,000 per year. And we will assume that she has receivables of $329, just to see how it works. So we will first book the sales, then book the receivables, and the rest will go to cash. In Excel, we will put a 1 here on sales, and we will enter the amount of sales if we have to modify it. It's set now at $10,000 per month. Then we will enter a 1 for receivables, and this will automatically calculate the cash. So we will have the $120,000 in revenue, and we will have the 329 on taxes. For step 2, we will say that her cost of sales is 30% or 36,000 of 120, and her payables are in 1 month. So first we will book the cost, then we will book the part of cost that goes into payables, and then we will reduce the cash by the difference. In this case, it will be 33,000. Her cost is 36. 3,000 goes into payables, so she's paying in cash 33,000. In Excel, we will enter first the cost of goods sold, or the percentage, which we said was 30%. And then we will put a 1 for the cost of sales and 1 for the payables. And now everything will be calculated. The cost of sales will be 36,000, the payables 3,000, and the effect on cash 33,000. And that will also be reflected on the balance sheet here for the payables, and on the P&L here for the cost of goods sold. The third step is about expenses, which we said were 43% of sales. So we will book expenses, or SG&A, for that amount. And we assume that she pays them in cash. So we will reduce the cash by that amount, SG&A and cash. So we go to the Excel file, we enter 43% for sales, for SG&A expenses as a percentage of sales. You can enter whichever number you want. And then we will put a 1 here on SG&A or expenses, and this will calculate both the amount and the net effect on cash. So now the income statement reflects the SG&A expenses, and it also reflects that the cash has diminished by that amount. I have also allocated the SG&A among salaries and benefits, marketing expense, rent and overhead, and you can modify this if you want. On the next step, we are going to look at how much money we have made. And if we stop here, we will have something called EBITDA, or earnings before interest, depreciation, and taxes. And we need to make the numbers tie. So if you think about it, we said that the earnings were $32,400. And now what's missing here is that we haven't booked that on the balance sheet. So all what we have to do is we have to go to this cell, earnings, put a 1, and this will recalculate everything. And now the earnings before taxes will be 32,400, and the balance sheet will type same number in assets and liabilities. This check here will show us if we're ever making a mistake. This should always be 0 or blank. The second step is about balance sheet items, which are a bit more complicated. So one thing that we want to do now is to adjust for inventory or book the inventory. And let's assume that she has 1 month of inventory. So first we need to calculate how much that is. And we always use cost of sales to calculate inventory. So if it's 1 month and the cost is 36,000, we do 36,000 divided by 12, and that will give us $3,000. So that will be her cost of sales for the inventory she has. So we're going to book inventory for $3,000. And because she pays in a month, we're going to increase the payables by the same amount. In Excel, we will go to step 2. We will put a 1 on inventory, and this will automatically calculate the payables. So now the balance sheet again ties. We have the inventory here and the increase on accounts payable there. The next step was property, plant, and equipment. Why don't we assume that she buys fixed assets or property, plant, and equipment both worth $10,000, and that she gets a loan for that for the same amount. So we want to increase property and equipment for $10,000, and we want to increase debt for the same amount. So on the Excel file, we will put a 1 for the capital equipment, and this will automatically calculate the debt, and it will increase the property, plant, and equipment for 10,000 and the debt for 10,000, and the numbers again tie. Now let's look into something quite more complicated called depreciation. Let's assume that the equipment has a life of 2 years. So we bought it for 10,000, and depreciation will be 50% per year because it's over 2 years. So we're going to increase depreciation by $5,000, and we will reduce the earnings by the same amount because our income is being reduced by the amount that we charge to depreciation. And at the same time, we're going to adjust the balance sheet for the same amount because now there is depreciation on the equipment of $5,000. So on the Excel file, we are going to put a 1 into depreciation and a 1 into property, plant, and equipment. And this will recalculate the depreciation, the reduction in property, plant, and equipment, and the effect on earnings. Our earnings now have been reduced by the same amount, and the property, plant, and equipment has also been reduced by the same amount. Before it was 10,000, and now it's 5,000. Interest. Let's assume that she borrowed $10,000 to pay for the equipment. So we want to make a transaction where we will increase interest by 5% of 10,000 or $500, and this will decrease the cash when we pay it. So we go to the Excel file and we put a 1 into interest, and that increases the interest and decreases the cash. And the balance sheet again ties. Now let's look into taxes. Let's assume that the tax rate is 20%. So we look at our earnings before tax, and then we calculate 20% of that. And we put it into the line called taxes. And then we reduce cash by that amount. That is done by putting a 1 here into taxes, that will calculate the amount, and it will reduce the cash by the same amount. Here is the reduction in net earnings, and here's the reduction in cash. And finally, we leave as a last step what in real life is done as a first step, but it's so that it'll be easier to understand the transactions. We are going to assume that Jenny got $10,000 in equity, and so we're going to increase cash by $10,000. The equity or the cash she got, she put it into her cash drawer or into her bank account, and the other side will be to increase equity by the same amount of $10,000. So on the Excel file, we just put a one here on equity, and that will increase the equity and it will increase the cash by the same amount. And now here's the equity and the cash has increased by 10,000. So all these numbers in blue can be changed for the numbers that you have for your small business. But let me go back to the first slide when I was showing the PowerPoint. And that is that to make it much easier for the cash flow, it's much better to plug the easiest transactions first. And the easiest in that order will be first sales, cost of sales, and then expenses. The net earnings or net income is a difference between sales minus cost and minus expenses. It's better to leave depreciation, interest, and taxes for later, for step 2, and the equity as a step 3. When you make the transactions, think about each one of them in a cash basis. Say to yourself, if I'm doing this, what is the effect that it has on cash? And that will make it much easier for you.